Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on understanding some major changes in the Finance Act 2021 and implications. President Muhammadu Buhari signed the Finance Bill 2021 into law on the 31st of December 2021, following the passage by the National Assembly. The act took effect on the 1st of January 2022. This is commendable as the government has enacted the Finance Act for the third consecutive year. The Finance Act is the headline fiscal legislation made annually, which allows the government to adjust taxes, duties, exemptions, and reliefs to support the budget. Some of the major changes we would focus on include capital gain tax on disposal of shares. The federal government has reintroduced 10% capital gain tax on the disposal of shares worth 100 million and above after 23 years of exemption. CGT is a tax on the profit realized from the sale of an investment, such as shares. This will apply in any 12 consecutive months, except when the sales proceeds are reinvested in any Nigerian company shares. This serves as an additional tax on investment in shares, with the current 10% withholding tax on dividend paid and 7.5% value-added tax on brokerage commission. The threshold of 100 million implies that a significant portion of retail investors will be exempted from CGT. Simplifying the CGT, if you buy 1 million units of GT Bank shares at 10 naira and sell when the share price appreciates to 15 naira, your profit is 5 million naira. CGT of 10% will be charged on the profit, which translates to 500,000 naira. Assuming the sales proceeds are not reinvested in any Nigerian company within 12 months. Also note that the worth of the shares is cumulative, meaning if you sell shares worth 100 million, e.g. 30 million in month 1, 40 million in month 6, and 30 million in month 12, you will be expected to render tax returns on the gains or the portion not reinvested. Effectively, investors will increase their stock return expectations to cover up for the capital gain tax. On the other hand, it will also encourage reinvestment of sales proceeds in Nigerian shares. 2. Excise duty on non-alcoholic carbonated drinks. This policy is known as sugar tax, which relates to the introduction of excise duty of 10 naira per litre on all non-alcoholic carbonated and sweetened beverages. An excise duty is a tax imposed on locally manufactured goods. This implies that Nigerians will pay more for carbonated drinks, especially low-income earners, due to the higher consumption of these products compared to the high-income earners. This may translate to about 5% increase in the cost of carbonated drinks. 3. Reduction of minimum tax rate. This act reduces the minimum tax rate from 0.5% to 0.25% of turnover, less franked investment income. That is income received that is already subject to corporation tax, e.g. dividend from a subsidiary. This applies to any two accounting periods between 1st of January 2019 and 31st of December 2021, as may be chosen by the taxpayer. The minimum tax is applicable to companies with no taxable profit or tax payable lower than the minimum tax computed. This will have a positive impact on businesses, as this reduces the tax burden on companies still struggling to be profitable. 4. Taxation of e-commerce businesses. This states that e-commerce businesses of non-resident companies would be taxed at 6% of turnover. For instance, if you visit Amazon or Alibaba to purchase an item, the company is expected to add VAT of 6% on that transaction. This is expected to be collected by the company and remitted to FIRS. Also, this applies to the promotion of products online like Facebook and Instagram. Effectively, this will increase the cost of purchasing items online, as well as promoting products online. This also impacts negatively on Nigerians. Overall, these taxes will further squeeze consumer wallets and reduce purchasing power. Besides, The Nigerian economy is still struggling and yet to revert to pre-COVID levels. Hence, imposing additional taxes on the populace may be counterproductive. The drive for the federal government to meet its expenditure without relying too much on borrowings must have prompted the various new taxes. Thank you for listening. Please join us same time next week for another exciting and interesting session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 070-8246-3747. Stay blessed.